Investors are concerned about UPS and FedEx stock given the increase in trade barriers and how negative that could be for these businesses in the near to medium term. So, investors have asked me to evaluate these companies and answer which one I think makes the better investment, if any, at these current lower prices. I'll review these two companies, compare them on critically important financial metrics, including revenue, operating profit, return on invested capital, and then I'll share with you my fair value calculations for UPS and FedEx, and I'll look at valuation on a forward price to earnings basis. And then I'll inform you on which one I think makes the better investment and what one is the better fitted to look ahead for the current economic times.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the first thing I wanted to compare these two companies on is revenue growth over the previous decade and provide my outlook for what I expect going forward. FedEx has increased its revenue from $47.5 billion all the way up to $88 billion, but is down from its peak of $93.5 billion. FedEx has grown revenue at a compounded annual growth rate of 6.7% in the previous decade. Meanwhile, UPS has grown its revenue from $58.4 billion up to $90 billion. That's good for a compounded annual growth rate of 4.7%, also down from its peak of $100 billion in 2022. The reasons these two companies are down from their peak revenue is because remember back in the pandemic or during the pandemic when people were spending more time at home, people were ordering more things online, and ordering more things online facilitates the need for more delivery, more transportation, more logistics, right in the wheelhouse for UPS and FedEx. Thankfully, in the longer term, I expect a larger percentage of spending to move online. Now, I don't expect 100% of spending to happen online, but I do expect a larger percentage of consumer spending to move online because it's just so much more convenient. And brick and mortar retailers are having significant challenges competing with online retailers or online businesses or online sales. You just can't beat that convenience advantage. And what I've seen from consumers over the previous 7 years is that people are willing to pay for convenience. And if you offer people convenience, they will make that choice. So in the longer term, they have that big tailwind behind them. However, in the shorter term, President Donald Trump implemented tariffs, which increased the cost of importing goods, which is going to increase the cost of all goods because it's a international supply chain. And when you restrict trade, it's going to create increases in cost. As prices increase in the near term, people are going to spend money on things and spend more money on services, spend more time at home, watch TV more, find different ways of entertainment, find different ways to spend their money. Furthermore, the rise in inflation is going to leave less disposable income in consumer wallets, which is going to lead to less spending as well. So in the near term, they are challenged, to be sure, no doubt about it. But longer term, that powerful tailwind, I think, outweighs those near-term tailwinds of the increase in cost of goods sold. And so I think longer term, these two companies will return to revenue growth in the mid-single digits, which would be great for shareholders. The next thing I wanted to compare these two on is the operating profit margin, and these are not very lucrative industries. These two companies generate relatively low profit margins. It's capital intensive, and the trends are not moving in their favor either. UPS generated an operating profit margin of 8.7%. That's down from 13% in 2015 and down from 14% in 2005. Meanwhile, FedEx generated an operating margin of 7.7%, down from 9.7% in 2016 and down from 9.3% in 2005. Very capital intensive industry, heavy labor and capital intensive. There isn't much that FedEx and UPS can do about it other than to try and find efficiencies where they can and make incremental improvements. The returns on investor capital also similar on the downtrend, 11.4% for UPS, down from 16.5% in 2016, 7% for FedEx, down from 9.4%. So UPS with the better number compared to FedEx, but the trend line's moving downward for each. I mentioned I would share with you my fair value calculations, and this is what you're looking at now. The intrinsic value per share for UPS I calculated at 121.62. That compares favorably to the current market price of $85. The share price is down significantly. It's trading near its 52-week lows. FedEx, meanwhile, I calculated an intrinsic value of $259.63 compared to the current market price of $230. FedEx stock looks undervalued as well. So when I go back to fiscal.ai, which is where I'm getting all these charts from, and I look at the forward price to earnings, they're selling at almost the same price. Forward price to earnings of 12.8 for UPS, forward price to earnings of 12.46 for FedEx. So comparing the two, they were similar across the board in a lot of the metrics and a lot of the trends. Valuation on a forward price to earnings is similar, but UPS, according to my DCF calculation, looked more undervalued. So if I had to pick between these two stocks, now remember I have both of them rated as a buy. I like their risk versus reward at these low valuations. I don't think these stocks are going to double your money overnight or over the next 3 years or over the next 5 years even. But I do think they can deliver steady returns I shouldn't say steady, but I do think they can deliver returns that exceed the rates of return on bonds in the United States for corporate and government bonds. So, given the added risk you're taking with these two stocks, I think they will deliver returns that exceed the risk. And so, you're getting a solid return for your investment. If I had to pick between these two, I would pick UPS as the better stock to buy.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.